Well, JB,
Derek, good to see you.
where are we today?
Interestingly, we're at Edinburgh Castle.
Edinburgh Castle, Edinburgh Castle, the most famous monument in the capital city of Edinburgh. Now, the castle was built in the 12th century and has been occupied since the Bronze Age. But anyway, enough of this. Should we talk investment?
Let's talk about castles. No, let's talk about investments.
Okay, let's do it. Speak later.
Welcome to DB Meets JB yet again. And here we are in the Sheraton in Edinburgh. And thanks to the Sheraton for allowing us to film, that was very kind of them. My name's Derek Borthwick. I am a Mind of Communication specialist and I help companies and individuals with their pitching, presenting, public speaking, selling and communication skills and strategies. And I am delighted to be joined today by my other half, JB Beckett. Welcome, JB.
Hello again, Derek.
Hello, and thanks for coming along.
Thank you.
Now, JB is an author, non-exec director, and well known to everybody in the industry as a bit of a fund selection legend. And with that in mind, and your industry experience today, we're going to be looking at a topic that is very, very topical with the FCA, but yet not everybody knows about this, JB. And it's something we'd like to explore more today. So it's essentially value. What does the FCA actually mean by value? If you could perhaps explore that and some of the implications of what's coming up in the next year.
Sure. So let's get the obvious out of the way that value for the asset management industry is not talking about a trip to Poundland. This has been coming for a few years now. And we've seen a couple of things. So the FCA, as the UK's prominent regulator for the asset management industry, engaged in this thematic review, the asset management market study.
Okay.
In that they were trying to pose a question, what does value for money mean? In its simplest way, I think we could all agree that intuitively that whatever the fund strategy, it should deliver some sense of value to its end investor, meeting the stated aims and meeting the expectations of the customer. So we can understand that. But the FCA didn't want to stop there, Derek. They wanted to take that further. They wanted to be more prescriptive in what that value assessment is going to look like. So they came up with 7 considerations, and it includes everything, as you'd imagine: cost, performance, service, economies of scale, how they treat different types of shareholder and different types of fund holder within the same fund. And fund boards are going to have to try to get their head around this by September this year.
Okay, great. Now, what does that, there's going to be some challenges there, JB. What do you think are going to be the main challenges that the industry is going to face with this? Perhaps you could explore this further.
So the backdrop to this is that the industry is already really struggling to come to terms with what the cost of fund management should be. And so we're going through a number of different regulations, most of which have come from Europe. One is obviously the Markets Directive, MiFID II.
Sure.
The other one is the Packaged Retail Product Directive, PRIPS. They have very catchy names. I can tell you they're far less catchy to read.
Sounds like a sweet, doesn't it?
It does. But what it exploits is that there is a lack of consistency in cost, and when different people and different organisations are talking about what cost and what that cost captures. So that's the backdrop, and that is going to be a real issue. The other is that the Investment Association, effectively the trade body for fund managers, and the Chartered Financial Analysts organisation, the CFA, have put out some guidance notes as to what best practice might look like in the test of value. Now, the UK here is drawing heavily on the US experience, and there we call it the Gartenberg rule, and that was because of an original case in 1982 where this chap called Gartenberg took Merrill Lynch to court. And we know the US has a very litigation-based system. And so we've been looking heavily at what they're doing. But for me, Gartenberg doesn't answer the question, because there it's about taking a fund group to court and trying to prove that the fees are excessive. Here we're trying to deal with something far less tangible. How do we generate value and how do we demonstrate value? And I think fund groups are going to really struggle with this, and there are a number of considerations we need to think about.
Yeah, absolutely.